Hello, and welcome to today's webinar, Mortgage Myths Dispelled. I'm Beth Hawley with the Arizona Association of Realtors, and we're proud to bring you these free webinars designed exclusively to keep you updated on issues in the industry. Joining us today is Ryan Halderson and Tim Nelson of VIP Mortgage. Ryan has been in the mortgage industry since 2001. He's been with Scottsdale, Arizona-based VIP Mortgage for the past 5 years, and his production for 2016 put him in the top 1% of residential loan officers in the U.S. Tim has been in the mortgage industry for 25 years. He began to focus specifically on reverse mortgages in 2009. In 2013, Tim became the first loan officer in Arizona to achieve the Certified Reverse Mortgage Professional designation. Today's presentation will be about 35 to 45 minutes. If you have any questions during the webinar, please write them in the question box and we will try to get them answered at the conclusion. As always, today's webinar will be recorded and available next week on our website at aaronline.com. So welcome and let's get started. Ryan, Tim, welcome.
Thank you. Unmute this.
Hit it one more time. Sorry, a little technical glitch. Can anyone hear us?
All right, I'm on. That was, I hit the wrong button. This is Ryan Halderson with VIP Mortgage. Thank you, Beth. So the class, we're going to split it into 3 sections. We're going to talk a little bit about VA loans and then FHA loans, and then Tim is going to talk about reverse mortgages. We'll probably do shorter. We'll probably do about 15 minutes on VA and FHA, and then heavier on the reverse mortgage portion, since that's in a lot of cases something that agents have probably never run into. So we'll go right into the VA portion of the slides. And so with VA loans, what I'll try to do is just kind of point out some different ahas of things that that agents may not have run into. The goal being to possibly find you a new buyer, and at the very least educate you for your next VA buyer, so that you're kind of more of a VA expert. So VA loans, the great thing about VA loans, they are 100% loans. If the veteran chooses to do down payment, they can, but they're allowed to do a 100% loan, and the best part about it is there's no monthly mortgage insurance on that 100% VA loan. So for anybody that's trying to get a low down payment loan that has VA benefits, it's the best loan going out there. Now, some things that that agents and even veterans might not know is that VA loans, while when you purchase a home, they have to be used to purchase a primary residence. So you could not ever use a VA loan to purchase a rental property. You could not ever use your VA loan to purchase a vacation home. But one of the things that VA does allow is that if you bought a home with a VA loan and you've lived in it for 12 months, 2 years, 3 years, whatever, as your primary residence, you are allowed to then move out of that home, leave your VA loan on it, even though you might turn it into a rental property and rent it out and make a profit on it. Now that's a good lead into the next bullet item, is that many veterans think that, okay, I can only use my VA loan one time and I can't use it again until I pay the VA back in full. In most cases, that's actually an incorrect statement. VA has what's called bonus entitlement, in which they say, essentially, you have a bucket of money in Maricopa County. That bucket of money is $424,000, and as long as your VA loan 1 plus VA loan 2, as long as those don't exceed that $424,000 bucket, so to say, you can do a second VA loan or a subsequent VA loan after that. So as an example, if somebody bought a house 20 years ago with a $100,000 VA loan and they still live in it, and they say, I want to move out of this house, I want to rent it out, and I want to go buy a new home and use my VA loan. They absolutely could, so long as that new home that they buy is a value of $324,000 or less, because we've got 100 already used up, and then they're using $324 on their new one. that's less than that bucket of money of 424, they're able to do that absolutely. Another thing with VA, if they said, well, shoot, you know, that $324,000 purchase price, that doesn't necessarily get me the house that I want. You know, I've worked hard. I want a bigger, better, nicer house. I want to do a loan that's $424,000, and I already have my $100,000 VA loan, and I don't want to sell that house. I want to rent it out. Once again, that's absolutely allowed, but the difference is your bucket of money, so to say, is now up to $524,000. The VA's rule on that is you can still do that, but at that point, the veteran needs to do a 25% down payment for every dollar above $424,000 that they went. So they went $100,000 above the $424,000 limit. That's about 25% of that's $25,000. So the veteran goes in and makes a $25,000 down payment, and they're still able to use their VA loan on the new home. You know, the good part about that is, why would they do that? Well, they would get the VA rate, which is lower than a conventional rate, and then they would also not have any mortgage insurance on the loan. And that concept applies. I talked about that concept in terms of, what if I have a VA home loan on my primary and I want to buy a second home? That was kind of the example I just gave. Another example that we could use is that same rule applies if a buyer says, you know, I don't have any VA loans outstanding. I had one 20 years ago. I sold that. Right now I have a conventional loan, or maybe I'm renting a house, and I want to go buy a big, nice house. VA says, well, if you go out, if you don't have any other VA loans, you can go out and buy a $424,000 house, and you can do a 100% loan. If the VA buyer says, but that doesn't get me what I want to go buy a house that's valued that's listed at $525,000 or $524,000, the same formula applies. VA says, okay, we're going to let you do that, but that's $100,000 higher than what our limit is of $424,000. The VA says you can absolutely do it as long as you do a 25% down payment on that overage that you did. So $525,000 is about $100,000 more than the $424,000 limit. You do a $25,000 down payment. Once again, what you walk away with is, you think about a $525,000 purchase price with $25,000 down, that's only about a 5% down payment. You're not going to find a jumbo loan on the open market that lets you do a 5% down payment. Along the same lines, you only did a 5% down payment on this jumbo loan, you're going to get a rate that's probably a shade under 4%. And oh, by the way, you're not going to have any mortgage insurance on that 5% down jumbo loan. So it's one of those things, if any of you agents are lucky enough to work with a high ticket jumbo buyer, maybe just throw it by them. Hey, by chance, do you have VA eligibility? Because if you do, you're going to turn them on to what conceivably could be, a great loan product that they may not have known about. Because once again, that's just kind of one of the quirks of VA that a lot of veterans don't know about. So that's kind of the, the bucket of money, so to say, that a lot of veterans and agents don't know about. Another one that, good or bad, hit our market and hit it pretty hard is, we had a lot of people that went into foreclosures and short sales. A lot of veterans think, oh, I had a VA loan. Unfortunately, I had to let it go into foreclosure, or I had to short sale it. A lot of veterans think that means I didn't pay the VA back, and that means I can't use my VA loan ever again. Once again, in most cases, that's not a true statement. Once again, VA has what's called a bonus entitlement, which is kind of a lender jargon. But basically what it comes down to is, in Maricopa County, where the max limit is $424,000, if you had a foreclosure or a short sale on a VA loan, in most cases you can still do another 100% VA loan up to about a $270,000 sales price. And there's a formula we use, but that's what it comes down to. And once again, if that veteran that had the foreclosure or the short sale, if they wanted to go higher than that, we'd use that same formula. If you want to go above that, you just do a 25% down payment on the difference that you go above that. So that's one of those things where, as I've taught classes over the years, I know that's got some agents, buyers, has got them buyers that they didn't know about, or that the veteran didn't even know about. So that's a good one that might be an aha for you. Another one that's just kind of housekeeping, probably 3 or 4 years ago, the VA changed the rule where a VA appraisal actually does not stick with the property anymore. It used to be, if a veteran tried to buy your home and they did a VA loan and there was a VA appraisal, that VA appraisal used to stick with the property for 6 months, and that it would stick with it. In if the appraisal came in low and killed the deal, and you wanted to try to resell it to somebody else, you would essentially have to take VA off of your list of eligible financing. That's not the case anymore. If a house falls out and there's already a VA appraisal, that new veteran that comes through actually does a new appraisal. So good or bad, but it doesn't stick with the property anymore. Another one that's confusing, and there's just no way around it, I'm going to try to explain it, and it's still somewhat confusing, is the good old VA non-allowable fees. So we've all probably, if you've ever done a VA loan, either with a listing or a buyer, you've heard about these, what are called non-allowable fees that the VA has. Once again, over the years, those non-allowable fees, the rules about them have changed. They're still confusing, but the good news is they're not nearly as restrictive as they used to be. It used to be there were these non-allowable fees and the seller had to pay them. The buyer couldn't pay them, or maybe the lender could pay them, or maybe the agent could pay them, but the buyer just flat out, the veteran was not allowed to pay them. That has actually changed. The VA still has their list of non-allowable fees. I won't go through them all, but just kind of in a Cliff Note version of what are these non-allowable fees. It's essentially the lender fees, which in most cases are going to be $1,500 or less. The buyer's escrow fees that the title company charges, that's typically going to be $500 or less. And then there's some other miscellaneous fees like the termite report and some other fees the title company charges. Once again, those are typically going to be $500 or less. So if we look at that bucket of non-allowable fees, that bucket, if you add it up, comes to, in almost all cases, $2,500 or less. One of the things that changed over the past few years, is that the VA has come out with what's called the 1% rule. The 1% rule is they say, hey, our intention was never that we stuck the seller with these fees. Our intention was that we didn't want the veteran to get taken advantage of by the lender or the title company. So what they said is, we'll allow that veteran to pay these non-allowable fees so long as they don't exceed 1% of the veteran's loan amount. So what I like to say is, if you think about it, if the non-allowable fees are $250 or less, $2,500 or less, and the veteran buys a home that's $250,000 or more, so his VA loan typically 100%, let's just say that it's a $250,000 purchase price, and he does a $250,000 VA loan, the VA says he's allowed to pay his non-allowable fees up to 1% of the loan amount, which is $2,500. You compare that to the non-allowable fees, those are $2,500 or less. The veteran does not need to ask anybody to pay anything on that transaction. He's perfectly allowed to ask the seller to pay his closing costs, just like a conventional buyer could ask the seller to pay his closing costs, but it's not the VA that's saying the seller has to pay these. And to kind of use the same philosophy, if the sales price was $200,000, well then that's 1% of that's $2,000, and those non-allowable fees on a high end might be $2,500. You could ask the seller for just $500. So, the myth about, oh, the seller has to pay all of those fees on a VA transaction, it's simply not true anymore. But like I said, a lot of buyers agents that work with a lot of VA buyers, they'll try to go into a listing and say, we're going to ask you for 3% because the VA says you have to pay 3% if you want that offer. That's simply not true. So the buyer is allowed to pay for their non-allowable so long as it doesn't exceed 1% of the loan amount. There are other ways around that too. When I work with VA buyers, I go over that rule with them and I tell them, hey, if you are searching in a lower price range, that doesn't mean you have to ask the seller for it. You can if you want, but there's other ways around it. Specifically, we could say, if we bumped up your interest rate by 1/8 of a point, we could give you a lender credit that would pay for those non-allowable fees or the delta for the non-allowable fees. Any lender can do that. If their interest rate's higher than what the market rate is, the lender makes more money, so to say, but rather than pocketing that, they give it back to the buyer in the form of a lender credit. And that's all the VA cares about, is that the VA buyer doesn't pay more than 1% of those non-allowable fees. So, kind of finishing off that topic, there still is somewhat of a negative connotation with, VA buyers or, listings or sellers who say, oh, we don't want to work with a VA buyer. If you happen to have a VA buyer, try to educate the listing agent going in, making the offer that, hey, this isn't a bad offer. And another thing that I encourage my veterans to do is to write a cover letter, just a couple of paragraphs about, hey, I served up my country and now I'm trying to buy a home for my family. A lot of times that can go a long way in changing a seller from, oh, I don't want to pay anything to, wow, this is somebody who served their country and maybe I could sell my home at a fair price and that would make me feel good. So I found that to be a good strategy for getting your VA offer accepted. So that kind of finishes up VA. Are there any questions on VA?
There are a couple of questions.
Okay.
One, is there a minimum time that you have to live in the property before as a primary resident?
Okay, so good question. The VA's intent when you do a VA home loan, and this goes for a conventional loan or an FHA loan, your intention is supposed to be that you're going to live there for 12 months as your primary residence. So long as you live there for 12 months, you'd essentially satisfy the lending rule on it. The IRS has some other rules that you'd want to talk to your CPA about, but as far as the lending side of things, the lender would want to see you live there for 12 months. On a case-by-case basis, it could be less than that. If it was like a job transfer or things like that, we can get around it. But typically, the intention is you live there for 12 months as your primary residence before you go out and buy a new home and get a new primary residence loan.
So what about a bankruptcy? Does that disqualify you from a VA loan if you'd already had one and then defaulted?
Well, the same rule is going to apply on a bankruptcy. When you file bankruptcy, you can either choose to include your mortgage in the bankruptcy or not include your mortgage in the bankruptcy. If you include your mortgage in the bankruptcy and then it goes through foreclosure, as in the bank takes it away, they would also take away your base entitlement. But then after they do that, that same rule would apply where you can still go out and get another VA loan so long as it's $270,000 or less. You still do have a disqualification period with VA where they say you would need to wait 2 years before you could do that new VA loan, but after the 2 years is up, even though you had a foreclosure or short sale, you could still do it so long as $270,000 or less was the sales price or the loan amount. So that finishes up VA, I think. So we'll move on to FHA, which isn't, it's got some quirks, but not nearly as many as VA. So we'll go through this a little bit quicker. With FHA, every year they evaluate the max loan amount. We had a little bit of a bump here in 2017 in that in Maricopa County, we can go up to $279,450 as the max loan amount for an FHA loan. So you compare that to conventional or VA, they let you go up to $424,000. With FHA, you are capped at a max FHA loan amount of $279,450. One of the other things that the VA changed, or I'm sorry, that the FHA changed here probably about 2 years ago, I'd say, is that the FHA is back to kind of their old-fashioned rule, in that FHA does not let you buy a home from a seller unless that seller has owned the property for 90 days. To me, I can't justify why that is. It's a silly rule that they ever had it and why they still have it, but that is the rule. So one of the things I tell agents when they're going out and working with FHA buyers, you can check the tax records on every listing before you go and look, but a tip-off is if it's a vacant, remodeled property, that's kind of like the warning sign to go off. Let's really, really check the tax record because that could be a fix and flip, in which case we couldn't even make the offer until the seller had owned that property for 90 days. So keep that in mind for your FHA buyers, or if you do work with investors that fix and flip. Another one with FHA, the appraisal does stick with the property. So in FHA's case, it sticks with the property for 120 days. Used to be 180 days, now it sticks with the property for 120 days, so roughly 4 months. And what that means is if an FHA appraisal comes in low and the deal falls apart, that same appraisal would be used for 120 days from the effective date of the appraisal. So if it did come in low and you were going to relist the house at the original list price and not drop the price to meet the appraised value, any other FHA buyer that comes through would be stuck with that same appraisal, and it's not a choice. You have to use it. It gets, when the lender sets up their case number with FHA, it red flags us and says an appraisal already exists for this property. With FHA, one of the things that's been helpful as we've kind of gone in and out of our housing crisis is that FHA is once again more of a kinder, gentler loan program. It's easier to qualify than conventional. It also has much shorter disqualification periods. So if you had a foreclosure or a short sale, FHA is only disqualifies you for 3 years, and then once the 3 years is up, you can go back to standard, do you qualify or not qualify? And then with FHA, their waiting period after a bankruptcy is only 2 years. So once again, once the bankruptcy is done, we just go back to, all the normal qualifications for an FHA loan. One of the things I'll forewarn on FHA loans, FHA approved condos are very, very difficult to find. There's a website that FHA has that has their list of FHA approved condos. Unfortunately, just kind of my, side of my hip estimate here, I would say probably less than 10% of the complexes out there are FHA approved. So I always tell FHA buyers, if you are looking at condos, A, it's going to be very difficult, and B, you really almost want to narrow your search to what zip codes you're looking in, and then search out what FHA complexes might be in that particular zip code, because it will be limited. FHA is changing some of those rules, but they're changing slowly, and they're not making the rules so easy that it's just going to be, a whole bunch of new ones coming on as FHA approved complexes. And then just to kind of finish up the FHA topic, kind of a nice offshoot, FHA is a 3.5% down payment. In Maricopa County, there is a Home in 5 down payment assistance program, and there's also similar programs with either the same name or maybe somewhat different names. I know for a fact that in Pima and Pinal County, they have very similar programs, and I believe in some of the other outer line areas, they also have similar down payment assistance programs that can get buyers in, like the Home in 5 program, for example, is a 3.5% grant, down payment assistance grant, and then you say, okay, well then I have a 3.5% down FHA loan, but I can get a grant for my down payment. You can get buyers into properties for very little out of pocket. There's still closing costs and prepaids, but along with the grant, you are allowed to ask the seller for contributions to pay closing costs and prepaids. So you can get buyers into properties for very little out of pocket by utilizing some of the grant programs that are out there. So that's just kind of the quick 1-2 on the FHA. Are there any questions on FHA? Doesn't look like it. Okay. Well, then I'm going to wrap up, and I'm going to let Tim Nelson talk about reverse mortgages and how you can use those for your purchase clients.
Very good. Thank you, Ryan. Some of the things that Ryan just mentioned regarding FHA loans do apply to the reverse mortgage. The reverse mortgage product is an FHA insured loan. So the appraisals, the condos, the foreclosures, bankruptcies, those things do apply with the reverse mortgage as well. But obviously the retired population, or 62 and older population, is growing tremendously, and there's 10,000 people every day that are turning 65. So and I think you're going to find that in this last bullet point, there was a 29% population growth of 60 and older borrowers moving into the state of Arizona last year in 2016. So as a realtor, there is a lot of opportunities if you're not looking at that age group and that segment of the population. There's a huge opportunity for that business, and I think a reverse mortgage is a product that is really starting to take off. As a company with VIP Mortgage, we're doing 3 and 4 purchases a month using reverse mortgages. So more and more borrowers, buyers, and agents need to be more familiar with how that works, because I'm going to show you some examples of how that can significantly improve the buyer's purchasing power. But the biggest problem that we deal with regarding the reverse mortgage product is the misconceptions around the product. And normally, this next slide I'm going to show you is what I like to use because of the misconception around the product. But when I'm meeting with people face-to-face, I always ask people, what is the color of a yield sign? And 90% of the people, probably 95% of the people in attendance in my CE class that we teach, everybody says a yield sign is yellow. So if you would now click the button, it's actually red, and it's been red for about 30 years. but people still think of a yield sign being yellow. And I give the analogy of the yield sign because the reverse mortgage is very similar to that. A lot of people think that a reverse mortgage is still yellow when actually it's red. And there's been a lot of changes to the product to improve it for the consumer. And we're going to cover some of those. A lot of people think that if you do a reverse mortgage, you no longer own the home, that the institution, the mortgage company, owns the home, and that's not the case. If you do a reverse mortgage is just a lien on the property like any other mortgage. So anytime you want to sell the home, you can sell the house, you pay off the reverse mortgage, and the remaining equity in the home is yours. A lot of people think the home needs to be free and clear in order to do a reverse mortgage. Well, that's not the case, because I'm going to talk to you about how a reverse mortgage can be used as a purchase transaction. Some people think when a reverse mortgage comes due that the bank or the mortgage company is going to sell the home. The owner, whether it's the parents or whether the parents pass away and the home goes to the heirs handle the transaction. They're going to sell the home. So the equity that's remaining in the home, whether it's the owners or the heirs, that equity is going to go to the heirs or the owner. A good way to think about it is when the lender lends money on a reverse mortgage, all the lender wants back at the end is the amount of money that was loaned to the borrower or the buyer, and the interest that wasn't paid or the interest that accrued during the time that they lived there. That's all the lender wants back at the end. All the remaining equity is the owners of the home. Okay? A lot of people think a reverse mortgage is only for desperate seniors who are house rich and cash poor. Reverse mortgages are now becoming very, very popular with financial planners because in many cases, homeowners, 50 to 60% of their estate value is tied up in real estate. So the product has improved, fees have come down, interest rates are much better. So people are looking at using home equity as a part of a retirement strategy because a lot of people don't have pensions. And a lot of people didn't save a lot of money. So in order to live off of more than just Social Security income, we're looking at different strategies and using a reverse mortgage, which is where the purchase transaction comes in. And number 5, I already covered that one. So this is an example of a traditional thought behind doing a reverse mortgage. So you have a 65-year-old couple that is going to downsize. Whoops. Well, in this example, we have a couple that's actually going to upsize. Okay. So, and actually there's a statistic that came out recently that 35% of retired people that look to downsize, they actually upsized. Now what they did was they got rid of the second story home, the big lot, and they moved into some of these retirement communities where it's a single story, small backyard, there's not a lot of maintenance involved, but the home is more expensive because of all the amenities that some of these properties have to offer. And so in this example, you have a $500,000 home and they're going to sell it, and after closing costs, they're going to net $460,000. So they're going to go out and buy a new home for $625,000. That means they're going to have to come out of pocket with $165,000. Now, when you're on a fixed income and you're retired, generally you don't want to have a mortgage payment. So without the reverse mortgage, they're either going to liquidate their retirement portfolio by $165,000, or they're going to go to Ryan and get a traditional mortgage. Well, instead of doing that, instead of liquidating $165,000 from a portfolio, or rather than going out and getting a mortgage for $165,000 and having a payment for the rest of their life, what they could do is the bottom example is to use a reverse mortgage to finance that $625,000 home. So in this case, again, they're going to sell the home for $500,000. After closing costs, they net $460,000. And for the $625,000 purchase price, we're going to do a reverse mortgage for $321,500. their down payment for this house is only going to be $303,500, which means out of that $460,000 that they netted from the sale of their home, they're only going to use the $303,500, and they're going to walk away with $156,000 in liquidity. When you're retired, do you want all your money tied up in that $625,000 home where you have an asset that's just sitting there not doing anything for you? Or would you rather be able to afford to buy that gorgeous home? They're 65 years old. This is the last home they're going to live in. They're used to having all these beautiful amenities and all these luxuries that this retirement community offers. This way, we have an affordable $625,000 home, and they still have $156,000 in liquidity, which when you're retired, liquidity in cash is king because that's what you're going to be living off of. So here's an example of how your borrowing power significantly increases because the people are downsizing because in most cases they're looking to create a better home to live in for the rest of their life, but they're also trying to downsize and create more liquidity. Here's a way that they can upsize, still create liquidity, and get that dream home. Next example. Okay. This example gives you, a lot of people don't really understand how a reverse mortgage works. So this is an amortization schedule on what a reverse mortgage is going to look like. Okay. So up on the top right-hand side, it shows $189,000 beginning mortgage balance. Okay. So you can see now the way the reverse mortgage works is the borrower does not make a payment. Now, a reverse mortgage does not offer free money. Sorry, you missed out on that special. That special went away. But the reverse mortgage, basically what it is it's allowing the borrower to live in the home, have a mortgage, but not make a mortgage payment. So what happens is the interest that they would normally pay is being deferred or added on to the loan balance. So the loan balance starts out, and the part of the screen up on the top is not, I can't read it. Oh, it is. $189,700 is the beginning mortgage balance. So you can see at the end of year one, the mortgage balance went up to $101,400. Okay, that's because they didn't make the interest payments on the mortgage. So 10 years down the road, the loan balance has increased to $345,000. They've lived there for 10 years and never made a mortgage payment. Now, I'm sure most of you are aware that on a traditional loan, when you do a 30-year mortgage, you're going to pay back 3 times the amount of money that you borrowed over a 30-year period of time. So the loan balance is going to grow over time. But let's look at the assumption that FHA uses on these loans is the property value is going to also increase on an average at 4%. So 10 years down the road, when the mortgage balance is at $345,140, that $350,000 value has increased to $518,000. So they actually have still $172,000 in equity in their home. Okay, so basically the home value and the mortgage balance are growing simultaneously. So 10 years down the road, they want to sell the home. They call you back. You list the property. You sell it for $518,000. You pay off the $345,000, and the buyer walks away with $172,000 in equity. That's a normal real estate environment transaction. But these are also FHA insured, so the buyer or the borrower is also insured in a worst case scenario. So let's pretend in 10 years down the road we go through another real estate crisis and the home values at $518,000 and the home values fall in half. Okay, and the home value goes down to $250,000 and they owe $345,000. the owner of the home has 3 responsibilities when they do a reverse mortgage. The 3 responsibilities are they need to continue to live in the home as the primary residence, they need to pay their property taxes and their homeowner's insurance. As long as they, if they also live in a PUD and they have a HOA fee, they need to pay the HOA fee as well. But as long as they continue to do those things and the home is underwater where they owe $345 and the home is worth $250, nothing changes. They continue to live there and they never make a mortgage payment. Okay? Now, if a crisis occurs and they need to move out and the home is underwater, then these loans are FHA insured and the owner is not responsible for a deficiency balance, nor are the heirs responsible for a deficiency balance if the parents have passed away and the home is underwater. These loans do have mortgage insurance on these loans, MIP. That is also being deferred, so they're not paying that separately, but there is a charge for that. But that's the insurance part that is so critical to the security for the retired people. So in a normal real estate environment, they leave, there's equity in the home, but in the worst case scenario, they're protected in case the value of the homes have gone down. Okay? Next screen. So who qualifies? You have to be 62 and older. NBS stands for non-borrowing spouse. This is one of the big advantages that have occurred recently. Sometimes you have a 62-year-old borrower and you have a spouse who's 58 years old. In the past, we would only be able to do the loan in one borrower's name. Now we can do it in both people are protected. So if the 62-year-old, 10 years down the road, the 72-year-old borrower now passes away, well, the 58-year-old in the old days is now 68, but because that person was not on the loan originally, that borrower is in a vulnerable position. But today we can put that 50-year-old, 58-year-old on the mortgage, so down the road when the older person does pass away, the younger person can continue to live in the home. Has to be a primary residence, which means they have to live there 6 months and 1 day out of the year. You have to have enough equity in your home. The equity position is based on the borrower's age, the youngest borrower's age. So if you're not going to live in that home, if you're going to live in that home for 10, 15, or 20 years and never make a mortgage payment, you have to have enough equity in the home to absorb the interest that's going to be accruing while you're not making a payment, accruing during the time you live. So the younger you are, the more equity you need to have, which means you have a larger down payment on a purchase transaction. Okay? So if you're 62 or 65 years old, which is the minimum age, in most cases you're going to be looking at about a 50% down on a purchase transaction. But if you're a buyer and you're 65 years old and you've bought and sold several homes in your past, generally you're not looking to put 5% down or 3% down. You're looking to put if you're thinking of not paying cash, you're putting a large payment down because you don't want a mortgage payment or you don't want a very large mortgage payment. So in most cases, a buyer that's in that 62 and older group is already planning on probably putting 50% down. But the down payment is that equity position that we showed you on the previous screen, which is the equity in the home. So part of the changes that occurred with reverse mortgages, buyers now need to qualify income and credit-wise. So it's much, much simpler qualifying than a traditional loan. We're not looking at debt ratios and credit scores. We look at what's their disposable income after all of their expenses. And as far as credit goes, somebody mentioned earlier that I've been in the mortgage business for 25 years. It takes me back to the old days where we didn't underwrite with credit scores. We underwrote looking at the past 24 months, how many 30s and 60s and 90 days were there. Well, That's how the reverse mortgage underwriting goes. We look at 30s and 60s and 90s over the past 24 months. You have to be a U.S. citizen. They have to go through HUD counseling. HUD, who oversees VA and FHA, requires third-party counseling. I tell people it's just to make sure that I've done my job and I've explained everything in detail as to how the reverse mortgage works. So HUD counseling is going to validate everything that I've already explained to you and to your client. Okay? And you can do a reverse mortgage on pretty much any property that that you've got. We can even do mobile homes if they own the land. But as Ryan mentioned, be very cautious with condominiums, because if they're not FHA approved, it's a long process and we'd never get it done prior to the purchase transaction. So make sure you're reviewing those condos to see if they're FHA approved. We just covered that, so we won't, well, actually non-eligible properties. You can't do an investment property, you can't do a second home, or mixed use properties for non-residential purposes. So that's the very, very short Reader's Digest version of a reverse mortgage. But I would say to everybody, the key to a reverse mortgage, number one, is don't be afraid of it, as far as it's not the horror stories that a lot of people have heard. What it really does is it allows the buyer to afford a bigger home. Rather than paying cash and tying up all your money when you're on a fixed income, you want to have liquidity. You don't want a mortgage payment. A reverse mortgage is a huge opportunity for that population. And if you can understand it well enough to at least get them in front of somebody who knows the reverse mortgage lending, in front of a loan officer that can explain it to them, that 62 and older population is huge. And it's growing, and many, many, many of those people, if you can get that business, is going to be a two-step transaction. They're going to sell one property and buy another property. So in many cases, you're going to have two transactions, and in about 35% of those transactions, they're going to actually be buying a bigger home the second time around. So I encourage you to reach out to me, and I've got plenty of information to share and get you comfortable with how the reverse mortgage product works, and that it's not the horror stories that you hear about as far as people getting kicked out of their home and people losing their homes and things like that. So thank you very much for your time. Well, questions?
So if the non-borrowing spouse isn't actually a spouse, but say a girlfriend or something, is that allowed?
Yes, yes, because there are, in that population, lots of times people don't get married, so they don't lose some of those benefits that they have from the previous spouse. So yes, that's not a problem.
And also, how do interest rates compare?
Interest rates are about 0.5% higher than what conforming rates are, but keep in mind they're not making a payment, the interest is being deferred. And so, yeah, you're looking at today you're looking at about 4.75 to 4.99, somewhere in that range.
Thanks, Tim.
My pleasure. Thank you, guys.
It was really informative, and Ryan, thank you very much.
Thank you.
I wanted to thank all of you for being our viewers today. I wanted to also let you know that our next webinar will be the premiere of AAR's new series, The Art of Leadership, on September 18th. So we hope to see you there. And thank you, and have a great day.